Digital Swordsman here. It's November the 4th, 2022. In this video, I'll describe or discuss the inescapable problems with trying to time the market, especially at extremes. So today, as you're probably aware of, we have the complete opposite of like 2 days ago. Commodities are rocking, dollar is tanking, markets up so. I mean, it's really commodities that are absolutely on fire today. I mean, copper up 7.3%, silver rocketing 6.2%, gold up a lot, oil, up quite a bit as well. But it's really, I mean, the interesting thing, first of all, is that the market, we haven't seen this type of behavior in quite, at least a few weeks, I think, where you actually have the market, typically when the metals have been up recently, the markets have been up almost as much, or at least above 1%. But now it's like the commodities, especially like copper and silver, have a life of their own. So that is, an interesting thing, I would just say. But what I want to touch on, because I recently talked to, one could say, a friend of mine. He's a mining investor in, he's precious miner investor, and he recently, I think he sold his entire mining portfolio 2 days ago or 1 day ago. Let's say somewhere around here. That is, of course, market timing. And I've said over, I think, the last 5 months in like tens of videos why I don't think that is a good idea at especially this point in time. But that is the hardest thing not to try to do, especially if you're down, let's say, a lot. And like I've said, the reason we or most people don't beat this sector is certainly not because you bought here instead of here, or even here instead of here, or even here instead of here, or even here instead of here. This is obviously a superior buy, but all of these would have ended up in the green. And of course, this is trading sardine, etc. So I'm just using this as a proxy, and we don't know, maybe Bear Creek Mining actually goes bankrupt and will stop being a good proxy, or maybe it goes back up here. Anyway, I still think it's a pretty good proxy. What I showed was that any time below, I think around this level, or I actually think it's higher. Let's say, I mean, sure, it's slanted a bit, but let's say around this level. You would, if you just bought at this level, held for minimum, let's say 2 years, you would be sitting at a 100% return in Bear Creek Mining. And any additional buy at a lower price point would give you even more. So if this, let's say, is not a mistake, because 100% in 2 years is great, everything below that just becomes a better buy by default. Again, assuming that this, stock is around, but we know the sector will be around. So I think the example stands on that merit alone, that we know that not all companies will go bankrupt. So I mean, just knowing that means that everything below that is like the point of no return. Because in this case, if we didn't know this wasn't going to go down to this level, we didn't know this time it was not going to stop here and go down here, but not down here. So it's like, and then we have today, for example. Okay, let's, the problem here is like, let's say you started to try and market time, because we had such a shitty day 2 days ago. Metals tanked, miners tanked, yada yada, dollar ripped, etc. After such a long downtrend, 2 years downtrend. Okay, how does in theory it sounds great. I'll just rebuy when the bottom is in. In theory, everybody agrees with that. Everybody knows. Everybody agrees with the idea of like, yes, everybody knows that you should buy low and sell high. That sounds really easy in theory. In practice, it's the complete opposite. Because let's say I sold out here, or sold out here. sold out at any point here really. What do I do when everything is on fire today? Do I buy back in? Okay, let's say I'm not convinced. Again, it's like by default, any buy around this point here is like extreme, and the cheaper these miners go, the more they will go up. So this is by default, in my opinion, a better buy than this, simply because it's cheaper. Without knowing what's going to happen, it could might as well have gone down. Still, it would be a better buy than this, and that is, what actually has happened. Anyway, going back to the point here. So we have a day like today. Everything's absolutely ripping. Even the senior miners are up to 8%. Okay, and we've sold out because, again, we can't stomach seeing more paper losses. We this time it's like we start to believe that, yes, the reason I can't beat this market is because I'm bad at timing bottoms, when nothing could really be farther from the truth. Because, again, this level ended up being a good buy, and every other buy just ended up being a better buy. So we're, in my opinion, in an absolute no selling territory right now, and it's just getting bonkers. I mean, the value of buying just has gone exponential over the last, especially last few months. Anyway, okay, so we sold here, let's say. What do we do now? If we buy back right now, we're paying a higher price. Okay. So if this was the bottom, we just accepted a worse return because we tried to time the market. And let's say, okay, I'm not convinced by this rally. We've seen, fake outs 2 years straight. So, you're pretty sure that it's going to go down more. So you're sitting on a, theoretical opportunity cost here because you sold and now it's up and you missed that. Okay. You permanented a loss here. But your belief again might be that, hey, I think it's going to go lower. Maybe I even think it's going to go way lower. The problem is, what if that does not happen? Let's say it goes up tomorrow or in the next 2 days at least. Okay, now you're starting to, well, I'm still not convinced that it's, the bottom. But okay, it has broken, let's say, if you could say this is a trend line. Yeah, let's actually say it breaks this, so it opens up around here, whatever. What do you do then? Let's say you're certainly convinced now that it is the bottom. Maybe that is not the bottom. So it goes down. So what happened in practice, even though good intentions, you paid up 8% for, and I don't know when you would sell out, but let's say minus 6.7 here or something. Okay, so you quote overpaid by 8.7%, which is the average that the stock market, what the stock market averages per year over the long term. And then you took a 6.67% loss on that. Whereas if the one who's just a dip buyer at all these times and increasingly buy the dip, his average would still be down here. So he would be back to even Steven from this point. He would actually be up a bit from the point that this market timer sold out, came back in just to take a quicker loss. That is a worse result than the one who did not try to time the market. But let's say you sell here and this was actually a fake breakdown and this was just, let's say, a retest and it goes back up. What do you do then? Do you buy back again and do the same thing? You buy higher and maybe then it will actually go down again. So can you see how easy it is for people to just lose money in a volatile sector by trying to time the market? Because the other ideas, let's say it doesn't go down here. Let's say it keeps on going and you haven't bought in yet because you're still not convinced. You want to see, I don't know what you want to see. Maybe you want to see it break this level, then you're absolutely sure it's the bottom. Okay. let's say you do that. So you sold here, you missed a 23% rally. And that is actually the fake breakout. So you missed a you paid up 23% more. And then let's say, who knows? Did you hold off? Did you sell here? Maybe it bounced again. And this was just a retest of this level. Or it goes down. Okay, is that a bottom or not? I mean, it's a higher high. When is the higher low? It might bounce on this trend line, for example. Let's say it goes something like this. Then it's still a higher low at least. But you still paid up 23% more than you could have bought it for here. And again, it's like, if this is actually the bottom, you're no better off than the one that did not try to time the market. So basically, it's like you have to be right. And nobody can predict when a bottom is in. That is the whole point. You know, that's why I keep harping on this. If you decide to go the market timing route, you pretty much have to be right. Well, you don't have to be right. I mean, sure, you could buy in here, and let's say this actually was the bottom, but you're no better off than the person who just kept on buying the lower end as something went. Because he's decreasing his average. You just jacked up your average. Let's say you took a 60% loss here. Then you paid 23% higher. Well, this person might have, again, bought all the way down, and he is actually, you know, up 23 on a larger position than when you're rebuying. So you have a higher cost basis versus this person, and will have lower returns on that cost basis. I hope, again, I hope this makes sense. Because when you think about it, I mean, it's like saving yourself from yourself. I have no idea knowing when the bottom is in. All I know is that forever in history, if you bought something, the cheaper it went, you made more money. Again, on average, assuming, you know, what you owned is still around, etc. I was more inclined to buy yesterday than today. But what do you do if you try to market time and are out of this sector? Maybe it actually goes down tomorrow. Let's say this trend line holds here and it actually goes lower. So the one that sold here feels smart about it. But how big of a difference is that really? Sold here, the one who held here, it's down here. Yes, sure, you could rebuy and have an extra 9%. And that is not a bad thing. The problem arises again because the same thing is going to or could happen. How do you know that this would be the bottom? Or how could you know this is the bottom? Maybe it goes down here. And the hodler, the one who knows that he's playing for the, you know, big money, the big swings going back to the next sentiment high, he just continues to buy, lowering his cost basis. So his average just has kept on decreasing because he's been buying. So it doesn't really hurt that person either relative to you. Sure, you get in a bit lower, but the other person is, you know, still 100% invested and just keeps on adding. And one day, the bottom will be in. And that means the lowest possible point. And nobody can predict that. It's just in hindsight that if you just keep on buying when something gets increasingly cheap, you will have bought the bottom and will be fully invested from the bottom tick. Whereas the market timer, there's almost no chance in hell he or she has done that. And as always, the problem arises that, okay, if you're waiting for, because typically market timers, I think they don't catch falling knives, they're waiting for evidence of the market having bottom. So I mean, if you sold here, it goes down, you just further increases your confidence in your market timing abilities. Like, yes, you have an example of this going right in the short term. But then again, let's say it goes up to here. So when do you buy back? Because the recent past is that, well, okay, this resistance here held, for example. Maybe you bank on this resisting holding as well. And maybe it doesn't hold. So then you're buying back here. But again, the value buying hodler, he just, his cost basis just gets lower and lower. So when you're up here and rebuys, for example, even though you looked right in the short term, this person who just kept on increasing his stack, his portfolio, he's gonna be up way more than he's gonna be up more than you right here, and going from this point to, I don't know, it might not look like much. Let's say you pay up 18%, but let's say, I mean, this is a larger minus, so it's not that much. But let's say again, the hodler has decreased his cost basis to this level because he kept on buying. So when we get up here, and let's again say that this actually is the bottom, he'll be up 76% on a larger portfolio, whereas the one who bought here, who timed the market, who looked smart in the short term, he's up 41. That's like, 2 years of difference. I mean, you would be happy to have an extra 38% return. A turning point is inevitable. This sector will not go away. And the value of buying as it goes lower and takes longer goes up exponentially. So to me, right now, market timing is probably the greediest thing you could ever do. And that is why I think, most people try to market time. You know me, I have never tried to market time. I've been all in since 2015. I just buy more and more. I'm waiting for more dry powder now. I don't prefer to pay more today for shares where absolutely nothing has changed except price of metals than I could have bought them for yesterday. So if I get dry powder on Monday and miners are still up, the return on that dry powder will be lower than if I bought yesterday. So I'm not too happy. I'm agnostic to what actually happens in the short term as long as I have some form of dry powder coming or expect to be buy, etc. I don't mind it, because if this for some reason was the actual bottom, who knows? It's like I absolutely have no idea. I will be 100% invested from the bottom tick, like I was from this tick, this tick, this tick, and will be from this tick. If it's not the bottom, I'll just keep increasing the shares I own. And hopefully some of the best stories will be even cheaper. So when this sector actually bottoms and they have made progressions, grown in value, my payday just will get larger. It's like the point is, short-term vol is up much. Short-term vol up is as much noise as short-term vol down. You shouldn't be, in my opinion, just happily buying more because miners and metals are up today, because they might as well be down tomorrow. If you want the big money, in my opinion, you should play for the big moves. Because again, if you start to market time, you'll start to try to predict every top as well. How on earth are you going to predict every top? No, I just know that pretty much, okay, I think I can hodl this sector until hopefully, if Bear Creek is around, we at least get to this sentiment environment again. And that would be, a 684% move, and might take 2 years. That is, that would be life-changing returns. That is what I'm after. I'm not after guessing the next 20% up or down. Because we know there will be a bottom, and when this sector bottoms, it typically rips pretty hard. And it's like the same here. It's like, yes, it ripped here, then, a pretty fat retracement, but that wasn't the top. All of a sudden, this was the top. And this was the bottom. It's like, who knows? I think from what I've heard, it's like, some newsletters, I think precious metal newsletters recommended selling miners during this COVID crash. Why? Because the technicals probably looked super bad, broken resistance, momentum was down, everybody was scared shitless. COVID was, end of the world type stuff. And I mean, that goes for me too. I thought, this COVID thing looks absolutely horrific. But I didn't sell anything because gold was, not really down as much. So it's like, okay, if price of the miners go down way more than gold, they just become, incredible buys all of a sudden. So I was, I held through this bottom and I was up for this top here. So I mean, I wouldn't keep harping on this idea, which both Howard Marks and Warren Buffett, etc., suggest as well. It's like market time. It's like I know it works. That has been my bread and butter. And you can listen to the smartest and richest long-term, long-only investors, and none of them really proclaim a lot of market timing. Sure, Howard Marks suggests that you should be more aggressive at some periods and more defensive at other periods. Sure, that you can do. I mean, I prefer alpha, as you know. It's like a company that, even though the sector sentiment goes down in the toilet, I mean, you have stocks that might, stay neutral or actually go up despite sentiment because they're creating so much value. In that case, it's like you will typically have lower downturns and pretty good upturns as well. Because yes, a stock like Bear Creek might go up 700% up to the next sentiment high, but if you're down, let's say 50% in down instead of, I don't know, 80-90%, and you go up 300%, maybe from a longer term perspective, you would actually have made more money because your dips are shallower. So you don't need to have 700% to just retrace to the next top. If you know what I mean. If you just held it through the dips, etc. of a alpha play. Higher lows, higher highs. And, the average compounding results, pretty good trend line. Whereas if, on the flip side, of course, is that if there was ever a time you would want to be, I think, in, let's say, cashed up, more optionality places, it would be at these extremes. That's when the future returns are the highest. Anyway, I hope you get what I'm saying and why it makes sense, in my opinion, to not try to time the market right now. I mean, I never really try to time the market, but especially now. Because you have absolutely no idea when the bottom is in. And you're probably gonna end up making mistakes and actually have worse returns than someone who did not try to pick a bottom and actually just continued relentlessly buying the cheaper it went. Because one day we know that a bottom will be in, and said person will have just kept on lowering his cost basis and will be in from the bottom tick. With, fully invested, let's say. That's my approach. That's what makes sense to me. And you can probably see that 95% plus of people do try to time the market, but 95% of people also underperform on an index. So I don't think you should be playing that game because that's what everyone else is playing. And it makes no sense unless you are like one of the best traders in the world who can, and you pretty much need to be right on timing. Otherwise, you're going to have an even worse return. And I don't know many people who for sure can. I mean, some of the people that are probably much better technical analysis, etc., than me, they might have screamed sell here. You can see how costly that is, or became. And you, as I say, you shouldn't judge it just based on results. So I'm not judging that. I'm just showing why it's much easier, in my opinion, to simply be one of the guys who write it out, have the fortitude, common sense, patience to just always be trying to buy as cheap as possible, and then have infinite patience. Yeah, that would be it for today. Again, I have no idea if this is a false rally or we go down further. I don't really care. If it goes lower, I'll just keep buying more. I get more for my money the lower this goes. So I'm quite agnostic. And if this is the bottom, I mean, I won't. I won't really complain about it because I'm 100%, again, invested from the bottom tick in that case, which might have been a few days ago. But other than that, if this is not the bottom, and maybe the bottom is around here, junior wise, maybe I've added 0.5% to my portfolio. Still, I will have, that would be worth it because that 0.5 might, turn out to be 800% return. So if that adds, let's say 4% to my overall returns going into the next sentiment high, 4% is still half. Even though it might not sound like much, you add 5% or whatever. If you get 4% extra to your total portfolio thanks to that additional small purchase, and you get an extra 4% in your portfolio, that is still almost half of what the stock market average per year. Big things have small beginnings, and I know how people work right now. It's like 90% have already sold. Let's say 7% might actually be able to hodl this, and it's like or maybe even a bit more than that, and like 1% actually has the stomach to just keep on buying. But that might be, again, like 1%. And like I pointed out in a recent video, it's like hodling is not, holding is not just better than selling and it's almost akin to buying. No, buying becomes exponentially better than holding, and holding becomes exponentially better than selling. So if you're a holder, you're probably gonna beat majority of people here if you can stomach this volatility. If you're a buyer, I think you're gonna beat everyone, 99%. But that is extremely hard because typically you end up trying to time the market, etc. And then you're not really a holder or a buyer. You're a market timer or a trader, and that typically don't end up that well. Again, my thoughts. Do your own due diligence. I'm trying to be helpful here. And again, I hope it makes sense. And like I said in the last video, you have to be disciplined at all times. You can't be disciplined all the way down and then start to be undisciplined and change the strategy all of a sudden. If your buys and sells don't match, you don't have a strategy. So I can't just be a buy and hold guy and then I switch to become a trader down here. You can't change if you have a sound strategy, you shouldn't change that. You should stick to it. Otherwise it's meaningless. Why if I buy and hold good companies, which has worked, and then all of a sudden it's like, I'm getting too rattled, and then I start to try to time the market. Then I'm not a long-term buy and hold holder. Then all of a sudden I'm a market timer like everyone else. Thanks for listening. Bye.